This is Economic Development Finance, and this is Chapter 4. We're going to be analyzing our business financial statements. In economic development, we're going to be asking what benefits will the firm or project provide, and how do these benefits fit the local economic development goals and strategies? Is the business plan sound, and does it provide the basis for success in the marketplace? What does the firm's financial condition and performance indicate about its capacity to support the proposed financing? And are financial projections realistic, and do they demonstrate the ability to repay the proposed financing? Ratios allow us to compare one company versus over time, or one company versus other companies over time. Ratios are used by lenders to determine creditworthiness, stockholders to estimate future cash flows and risk, and managers to identify areas of weakness and strength. Ratio analysis involves methods of calculating and interpreting financial ratios to analyze and monitor the firm's performance. So why should we look at financial ratios? It helps us determine if companies are creditworthy. Only a small portion of overall business analysis. We also have to look at the industry characteristics, agency issues, strategy of the company. There are multiple types of ratios that we're going to look at. But first we're going to look at the two ways that you can compare either an industry to itself or to others. So a cross-sectional analysis is the comparison of different firms' financial ratios at the same point in time. So you're comparing one company to its competitors at the same point in time. The important thing to do is to identify your industry correctly. So if you remember back when we talked about Mergent, I showed you how to add competitors to your industry analysis, so that way you could define your industry exactly how you chose. A specific type of cross-sectional analysis is benchmarking. This is where the firm's ratio values are compared to those of a key competitor. Benchmarking allows you to compare yourself to someone that you want to emulate. It's also popular to compare yourself to industry averages. So here we are looking at some different ratios for various industries. And you see that you need to make sure that you compare your industry to similar stores. So yes, Walmart is a grocery store, but they're also a merchandise store. So identifying whether or not you want to compare them to Kroger or to Big Lots or to Sears. These are decisions that you have to make independently, but each have different ramifications. But this is an example of cross-sectional analysis. So we're comparing one company to its key competitor, such as Lowe's to Home Depot. That would be a type of benchmarking, a type of cross-sectional analysis where Lowe's is comparing itself to its key competitor. But this is cross-sectional analysis in general too. So, for example, Dell is being compared to the computer industry. That is cross-sectional analysis. Time series analysis is evaluating a firm's financial performance over time. So we compare current to past performance using ratios, and this allows us to assess a firm's progress. We can see developing trends when we use multi-year comparisons, but the most informative approach is to use both cross-sectional and time series analysis together. So if we were to look at the yellow line alone, so ignore the blue line, that would be an example of a time series analysis. So we're seeing how Bartlett Company's average collection period has changed over recent years. When we include the industry averages as well, that's a combined analysis. So not only are we comparing Bartlett Company to itself across time, we're comparing Bartlett Company to the industry and itself across time. There are some cautions when using financial ratios, and there's some major limitations. Ratios reveal the possibility of a problem. They don't necessarily mean that there is a problem. It means there might be a problem. A single ratio does not provide sufficient information to judge overall performance. When calculating ratios, you should use financial statements dated at the same point in time. It's preferred to use audited financial statements. The financial data being compared should be developed in the same way, and results can be distorted by inflation. There are some limitations with financial ratios. Different firms use different accounting procedures, so there may be some window dressing issues. Seasonal and non-current items and events may distort financial performance, and there is no underlying theory that helps us establish benchmarks. It's also difficult to evaluate conglomerates from the consolidated financial statements. Additionally, generally accepted accounting principles are not applicable to all international companies. The first type of ratio that we're going to look at is a liquidity ratio. Liquidity ratios ask if the company can meet its short-term obligation using the resources that it currently has on hand. So the first liquidity ratio that we'll use is the current ratio, and that's defined as current assets over current liabilities. To calculate these ratios, we are using the Chapter 3 handout available on Canvas. It's Bartlett Company Income Statements and Balance Sheets. So the current ratio determines how well a company can pay its short-term liabilities with its short-term assets. The theory is that the more liquid assets a company has, the more ability they have to pay their short-term obligations. So looking at the Bartlett Company income statements and balance sheets, we can calculate the current ratio. So the current ratio is equal to current assets for 2012, 1,223. These are reported in thousands, divided by current liabilities of 620,000. I found these numbers on the balance sheet, current assets, and current liabilities. And this gives us a current ratio of 1.97. So is this good or bad? A current ratio that is greater than 1 is generally considered good. If the current ratio were less than 1, then the company may have problems in the future. This may not always be the case. If a company is too conservative, they will hold too much of their assets in cash instead of investing them, which would cause their current ratio to be very high. Or if they're too aggressive, then they may be unable to borrow from banks, and they may not have any way to borrow money. In theory, all current assets can easily be converted to cash, but this is not always the case. The value of inventory reported on the balance sheet may not be an accurate representation of what it's actually worth. So suppose that you're a manufacturer of Thai Beanie Babies. I don't know for certain, but I imagine there's not a huge demand for Thai Beanie Babies anymore. So if you have 10,000 Thai Beanie Babies in your warehouse, you may have them reported as being worth X amount of dollars, when in reality, you can't sell them for that much money. Large companies usually have well-established relationships with banks that can provide lines of credit and other short-term loan products. This makes them not need to have large stores of cash on their balance sheet. For example, if you look at our ratios that we just viewed right here on slide 6, you see that Lowe's and Home Depot have a current ratio that is half the industry average. Large companies generally have these well-established relationships with banks that they can access if they are facing liquidity problems, so they don't need to have large stores of cash. So, although inventory is seen as a current asset, we just discussed how it may not be, the value of the inventory may not be representative of its true market value. So if your company is doing poorly, the inventory that you hold may not be worth what you think it is. So a more conservative measure of liquidity is the quick ratio. The quick ratio is equal to the current assets minus inventory divided by current liabilities. We can do this for Bartlett Company. So we know our current assets found on the balance sheet is 1,223. If we subtract off inventory, that's 289. And we divide by current liabilities of 620. This gives us a quick ratio of 1.51. Again, this is measuring how easily we can pay our short-term obligations. And again, higher is better. A quick ratio greater than 1 is generally considered safe. Inventory is very important. If we compare Dell, Home Depot, and Lowe's, we see that all three have a current ratio of 1.3. If we look at the more conservative ratio, if we look at the more conservative measure of liquidity, the quick ratio, we see that their quick ratios are drastically different. This means that Dell is not holding a great amount of their goods and inventory, which is probably a good thing because Dell is in the technology industry, which is changing swiftly. So if they had a whole bunch of processors in their warehouse, by the time they were actually able to use them, they probably wouldn't be worth nearly as much as what they had written them down as. Home Depot and Lowe's are in a different category. When you look at Home Depot and Lowe's, they have humongous stores with tons of inventory, things such as lumber and siding, things that aren't going to lose a lot of value. So it makes sense that their quick ratio is significantly lower than their current ratio because they are holding large amounts of inventory. Asset management ratios measure how efficiently a firm uses its assets and how much the firm has tied up in assets for every dollar of sales. We're going to look at inventory turnover, which is cost of goods sold divided by inventory, which measures, again, how efficiently the firm operates. So if we apply this to Bartlett Company, we see cost of goods sold is found on the income statement. That is $2,088. And we divide that by our inventory levels, which is found on the balance sheet, 289. And we see 7.2. So the inventory is turning over 7.2 times per year. We can also calculate the average age of the inventory, which is 365 divided by inventory turnover. Applying this to Bartlett Company, we see 365 divided by 7.2, and we get 50.7 days. So the average piece of inventory for Bartlett Company is sitting on the shelf for 50.7 days. Again, these ratios are going to vary drastically by industry. Just imagine a car lot. If Bartlett Company were a car lot and the car were sitting in the car lot for 50.7 days, that may not be so bad. But if Bartlett Company were a grocery store and this was a head of lettuce that we were talking about, that would be horrendous. Another measure that we can use is the average collection period. This is also known as, aka, days sales outstanding. And is equal to accounts receivable over average sales per day. We can calculate this for Bartlett Company. We see that accounts receivable is 503, found on the balance sheet. And we divide that by annual sales found on the income statement, 3,074 over 365. If you work this out, you'll have 503,000 over 8,422, and that's equal to 59.7 days. Again, this number is going to vary by industry. Grocery stores usually sell to people using cash and credit cards, while auto dealers finance cars and negotiate agreements with vendors who agree to pay for the car after the sale has been made. Companies in the building, materials, grocery, and merchandise stores usually collect in just a few days, while firms in the computer industry take roughly 2 months to collect on their sales. The difference is primarily due to the fact that these industries serve very different customers. So the average collection period needs to be examined by the industry. Average payment period, that's equal to accounts payable over annual purchases. Annual purchases are not something that you'll find on the income statement or balance sheet, so you have to make assumptions. So we'll suppose that purchases are 70% of its cost of goods sold. So then we would say that purchases would be equal to 70% of our cost of goods sold is found on the income statement. And that is equal to $1,461,600. So we can calculate this for Bartlett Company. Accounts payable is $382,000. And we divide that by accounts payable is found on the liability and equity side of the balance sheet. We divide that by our purchases over 365. And that gives you 95.4 days. So again, this is how long it takes to pay their bills. Total asset turnover. How quickly are our assets turning over? Sales over total assets. For Bartlett Company, we have sales in 2012, 3,074. We divide that by our total assets, found on the balance sheet, 3,597. And that gives us 0.85. The grocery business turns assets over faster than any of the other industries, and that makes sense because their inventory is among the most spoilable, for lack of a better word. They have to sell their baked goods and their dairy products and their produce quickly, or they're going to have to throw them away once they do spoil. On average, a grocery store has to replace its entire inventory in just a few days or weeks, and that contributes to the rapid turnover of the firm's total assets. Again, if you're comparing 0.85 to a car lot, that may not be a bad number at all. You just need to make sure that you've defined your industry correctly. So days sales outstanding, that's the same as the average collection period, which we already did. Fixed asset turnover. This ratio measures our ability to generate sales from fixed assets. It's most often used in the manufacturing industries. When companies make large purchases, investors watch this ratio to see how effective the investment was. To calculate the fixed asset turnover, that's sales over net fixed assets. For Bartlett Company, our sales are 3,074. We divide that by net fixed assets. Net fixed assets are on the balance sheet, the asset side, 2,374. And that's 1.29. Again, each of these ratios need to be compared to industry averages or against the firm itself over time. So you need to either do a cross-sectional or a time series analysis to make sense of any of these ratios. Debt management ratios. Does the company have too much debt? Can the company's earnings meet its debt servicing requirements? So the first debt ratio that we're going to look at is the debt ratio, and that's total liabilities over total assets. The debt ratio takes into account all debts to all creditors. And for Bartlett Company, our total liabilities is found on the liability and equity side of the balance sheet. And total liabilities is 1,643. We divide that by our total assets, 3,597, also found on the balance sheet, to give us 0.457. So 45.7%. That means that 45.7% of our assets are financed. The times interest earned ratio is equal to earnings before interest and taxes divided by interest. If you'll notice on our income statements, operating profits and earnings before interest and taxes are the same thing. I went ahead and wrote that on the income statement for you. So if we calculate this for Bartlett Company, we see our earnings before interest and taxes is 418. We divide that by our interest expense, 93, and that gives us 4.5. So for Bartlett Company, this means that Bartlett Company makes enough to cover its interest expense for 4.5 times. So a higher times interest earned ratio is better. It means that a company can afford to pay its interest payments. Profitability ratios measure a company's rate of return on sales or assets or just about anything. First, we'll look at gross profit margin, which is sales minus cost of goods sold over sales. For Bartlett Company, sales is $3,074. Subtract our cost of goods sold found on the income statement and divide that by sales. And you get 32.1%. So when we deduct only cost of goods sold, this company is keeping 32.1 cents of every dollar sold. This is the least restrictive definition of profitability that we use. The next that we're going to look at is the operating profit margin, which is operating profits, so earnings before interest and taxes, over sales. So for Bartlett Company, our earnings before interest and taxes, or our operating profits, is found on the income statement, $418. And we divide that by sales of $3,074. And that's 13.6%. So once we've accounted for our cost of goods sold, our selling expenses, our administrative expenses, depreciation, our lease expenses, and our operating expenses, once we've covered a lot of our expenses, we're still keeping 13.6 cents of every dollar sold. The most restrictive definition of profitability that we're going to look at is the net profit margin, and that's equal to earnings available for common shareholders over sales. Earnings available for common shareholders is found on the income statement, $221. Divide that by sales, and we get 7.2%. So once we've accounted for all expenses, we are keeping 7.2 cents of every dollar sold. A common profitability ratio is earnings per share. This is equal to earnings available for common shareholders over the number of shares of common stock outstanding. For Bartlett Company, earnings available for common shareholders is 221. Again, remember those are thousands. And we divide that by the number of shares of common stock outstanding. And if you see footnote B of the income statement, it says that common stock outstanding was 76,262 in 2012. So that gives us earnings per share of $2.90. If we want to look at return on assets, that's earnings available for common shareholders over total assets. Earnings available for common shareholders is $221,000 over total assets on the balance sheet, $3,597. And again, these are in thousands. So that's 6.1%. So for Bartlett Company, this return on assets means that every dollar of assets earns 6.1 cents. So it measures how well a company converts assets into profits. Again, higher is better. Return on equity, how well is the company using owners' money, is equal to earnings available for common shareholders over common stock equity. So earnings available for common shareholders, that's found on the income statement, 221. And we divide that by common stockholders' equity. And that's calculated as total shareholders' equity minus the preferred stock, so 200. That's 221,000 over 1,754, and that's 12.6%. Basic earning power is equal to earnings before interest and taxes over total assets. Higher is better. A higher basic earning power means that the firm is more effective at generating income from assets. It allows comparison across companies with different taxes and leverage because it looks at earnings before taxes and interest. So here, for our company, we have earnings before interest and taxes of $418,000 and total assets of $3,597,000. So that gives us basic earning power of 11.62%. So our basic earning power less our return on assets, 11.62 minus 6.1%, would be equal to 5.5%. So 5.5% of our revenue is expensed out as interest expense and taxes. Return on assets is lowered by debt because interest expense lowers net income, which also causes a lower return on assets. The use of debt lowers equity, and if equity is lowered more than net income, ROE would increase. Market value ratios will be covered next. So high levels of earnings and cash flow increase market value ratios. High expected growth in earnings and cash flow increase market value ratios. And high levels of risk decrease market value ratios. The first that we're going to look at is a price-earnings ratio. The price-earnings ratio is equal to the market price per share of the common stock over earnings per share. So first you would need to know the market price of common stock. So Bartlett Company is trading for $32.25 at year-end 2012. So we can use this to calculate our price-earnings ratio. Market price, $32.25 divided by earnings per share, found on the income statement at the bottom. We also just calculated that at $2.90. That's 11.1. A high price-earnings ratio means that investors expect an increase in earnings growth. It tells you how much investors are willing to pay for every dollar of earnings. You can use the price-earnings ratio to calculate the intrinsic value of your stock using the price-earnings multiple. Market-to-book ratios. The market-to-book ratio is equal to the market price per share of common stock over the book value per share of common stock. The first step is to calculate the book value per share of common stock, which is equal to common stock equity over the number of shares of common stock outstanding. So if we get the book value, we have common stock equity. Remember, that's the 1,954 minus the 200 in preferred stock divided by number of shares of common stock outstanding. Footnote B of the income statement, 76,262. And that gives you $23 per share. So you can use that to determine your market to book ratio. So the market price we just said was $32.25. Divide that by the book value of 23. And you get a market to book ratio of 1.4. What does this mean? If the market to book ratio is greater than 1, the stock is undervalued. Please scratch that, I just said it backwards. If the market to book ratio is greater than 1, that means the market price is greater than the book value, the stock is overvalued. If the market to book ratio is less than 1, the market price is less than the book value, then it's undervalued. This is what we just did. So the price-earning ratio tells us how much investors are willing to pay for every dollar of earnings. Higher is better. Market to book tells how much investors are willing to pay for every dollar of book value. Higher is better. The price-earnings multiple and the market-to-book ratio are high. If the return on equity is high, risk is low. So another way to analyze the balance sheet and income statement is to do a common size balance sheet. So here we divided all items by total assets to determine their percentage makeup of the balance sheet. So we can continue. This is still dividing all items by total assets. And we can look at things by change, so we can see how the percentage change in items from one year to the next. So sales have increased 19.8%, cost of goods sold had increased 22%, operating expenses have increased 2.7%, net income increased 56.1%. So the company has become more profitable. So you can do this for the balance sheet too to determine how much things have changed. Cash has increased 26%. Total assets have increased 10%. Inventories have decreased 3.7%. Accounts payable increased. Notes payable decreased. We also have the DuPont system. This allows us to focus on expense control, asset utilization, and debt utilization. It shows how these factors combine to determine return on equity. So the DuPont system, profit margin times total asset turnover is equal to return on assets. You see that when you break them down. So profit margin is equal to net income over sales times sales over total assets. Sales cancel out. That gives you net income over total assets, which is return on assets. If we multiply the ROA by the equity multiplier, then we get return on equity. So if you look at this via formula, net income over sales times sales over total assets, the sales cancel out, then multiply that by total assets over common stockholders' equity, and the total assets cancel out. So that's net income over common shareholders' equity to give you return on equity. So this ties together profitability, asset efficiency, and the use of debt. So here if we were to look at this for Bartlett Company, we see that net income is $221,000 over sales multiplied by sales over total assets. That gives you ROA of 6.12%. Now you could do the same thing here. So you take your ROA times the equity multiplier, your 6.12%, times your equity multiplier, 3,597 total assets, divided by your common shareholders' equity. Remember that's the 1,954 minus the preferred shareholders, and that would give you 12.6%. So ROA, that means that this company made 6.12 cents on every dollar of sales. Oh, I'm sorry. Excuse me. Their profit margin was 7.2 cents, so 7.2%. So they made 7.2 cents on every dollar of sales, and assets were turned over 0.85 times during the year, so that makes ROA 6.12%. Firms that have a lot of leverage have a higher equity multiplier because assets are financed with a relatively smaller amount of equity. So if we take our ROA, the 6.12%, and multiply that by our equity multiplier, then we have ROE of 12.6%. So this should say 2011. So in 2012, ROE was 12.68%, and in 2011 it was 8.61%. So it did increase. You see that whenever we look at things via the DuPont system, we can see where these changes come from. The equity multiplier has been pretty much constant. Total asset turnover, it's varied a little bit. A large change has been profit margin. So the profit margin has significantly increased in 2012. We compare this to the industry, we can see where our numbers are drastically different. In 2012, our profit margin was double the industry, but our asset turnover was less than half that of the industry. So there are some potential problems and limitations with ratio analysis. Comparison with industry averages is difficult if the firm operates with a large amount of divisions. Seasonal factors can distort ratios. Window dressing techniques can make statements and ratios look better. And different accounting and operating practices can distort comparisons. There are qualitative factors to consider when doing a ratio analysis. There's larger risk if our revenues are tied to a single customer or product, or we rely on a single supplier, or if a high percentage of our business is generated overseas. We also need to look at the competitive situation, what new products are coming down the pipeline, and legal and regulatory issues. That's it for Chapter 3. Remember that for Chapter 4, you're going to need some sort of financial calculator. We also have the DuPont system. This allows us to focus on expense control, asset utilization, and debt utilization. It shows how these factors combine to determine return on equity. So the DuPont system, profit margin times total asset turnover is equal to return on assets. You see that when you break them down. So profit margin is equal to net income over sales times sales over total assets. Sales cancel out. That gives you net income over total assets, which is return on assets. If we multiply the ROA by the equity multiplier, then we get return on equity. So if you look at this via formula, net income over sales times sales over total assets, the sales cancel out, then multiply that by total assets over common stockholders' equity, and the total assets cancel out. So that's net income over common shareholders' equity to give you return on equity. So this ties together profitability, asset efficiency, and the use of debt. So here, if we were to look at this for Bartlett Company, we see that net income is $221,000 over sales multiplied by sales over total assets. That gives you ROA of 6.12%. Now you could do the same thing here. So you take your ROA times the equity multiplier, your 6.12%. Times your equity multiplier, 3,597 total assets, divided by your common shareholders' equity. Remember, that's the 1,954 minus the preferred shareholders, and that would give you 12.6%. So ROA, that means that this company made 6.12 cents on every dollar of sales. Oh, I'm sorry. Excuse me. Their profit margin was 7.2 cents, so they 7.2%. So they made 7.2 cents on every dollar of sales, and assets were turned over 0.85 times during the year, so that makes ROA 6.12%. Firms that have a lot of leverage have a higher equity multiplier because assets are financed with a relatively smaller amount of equity. So if we take our ROA, the 6.12%, and multiply that by our equity multiplier, then we have ROE of 12.6%. So this should say 2011. So in 2012, ROE was 12.68%, and in 2011 it was 8.61%. So it did increase. You see that whenever we look at things via the DuPont system, we can see where these changes come from. The equity multiplier has been pretty much constant. Total asset turnover, it's varied a little bit. A large change has been profit margin. So the profit margin has significantly increased in 2012. If we compare this to the industry, we can see where our numbers are drastically different. In 2012, our profit margin was double the industry, but our asset turnover was less than half that of the industry. So there are some potential problems and limitations with ratio analysis. Comparison with industry averages is difficult if the firm operates with a large amount of divisions. Seasonal factors can distort ratios. Window dressing techniques can make statements and ratios look better. And different accounting and operating practices can distort comparisons. There are qualitative factors to consider when doing a ratio analysis. There's larger risk if our revenues are tied to a single customer or product, or we rely on a single supplier, or if a high percentage of our business is generated overseas. We also need to look at the competitive situation, what new products are coming down the pipeline, and legal and regulatory issues. That's it for Chapter 3. Remember that for Chapter 4, you're going to need some sort of financial calculator.